Okay, good afternoon, everybody. This is Budget and Taxation Committee 22. It's exciting to be back and have you all with us. We're going to do a very short organizational meeting, and then we'll roll right into today's briefing. Just a couple things that I know you're probably all aware of on some level anyway, is that at least for the first month, we're going to be doing hearings and briefings through Zoom, and we'll be doing voting sessions in person. So we will eventually get to come together, which will be good, and I'm looking forward to that. As far as what's ahead of us in the next week or so, today, of course, we have Dan White, the director of Moody's Analytics, which we always look forward to every year to get a big picture of the economy. Next Tuesday and Wednesday, we will have bill hearings, and there are 11 bills on each day, so you can plan accordingly your time. Next Thursday, we're going to have briefings, and there will be 3 briefings. Anticipate that that'll be about an hour and a half total at max. And then, of course, the budget will be coming in. And on the 24th at 3 o'clock, we'll have the fiscal briefing with DLS, which really is going to kick off everything with the budget hearings. As far as organizational information and packets and such, they'll all be emailed to you, so we're not going to go over any of that. And I should say, though, that certainly feel free to ask questions wherever need be about that or anything else. You guys, members, certainly feel free to have your staff reach out to Deanna and my staff and set up anytime you want to talk about anything. And quite frankly, if you just want to try to pop in, certainly feel free to do that. It's certainly, I'm certainly happy if I happen to have a moment, I'd be happy to chat with you about anything. We have coming back, of course, our crack team of analysts, Erica and Philip and Matt, and Kim is our committee manager, and I'm going to have her quickly introduce her new team, some of which is not new, for this session.
Okay, first we have new to us is a receptionist, Florence Smoot. Florence, if you could wave, that's Florence. Jane Wampler is returning again. She's sharing a little spot with Florence, and Jane is gonna be the EBA person this year. We have Will Elder coming back, and Will be HHS and Capital, and I will be doing PST&E and full committee. So those are the capital assignments. I'm sorry, operating assignments. So that's it.
Great. And if you have any questions about procedures that might be confusing, maybe even to the public or to whoever about how they get testimony and all those issues, direct them all to Kim, and she will be happy to help figure out whatever issues that there may be. I wanted to also mention so as you know, as the president has laid out for us, each office gets to determine how sort of the traffic flow from outside the office, particularly from the public. And so what you should know about the suite, which is the suite here that I'm in, and that we're all the staff is in, and Senator Jackson we're all working up here under the rule of and so this applies, I guess, if you want to bring somebody in from the outside to have a meeting with me or someone, that they must have proof of vaccination. So that is our rule up here. I think that is pretty much it. Are there any questions that anybody has? Okay.
Mr. Chairman?
Yes.
Thank you. You mentioned that you'd be available for us to kind of drop in or stop in. Are you going to have office hours, or do you plan to be in, for example, on Mondays, just so that I can?
Yeah. No, I will be in probably most days. I don't have set office hours.
Okay.
But I mean, if you really want to make sure that when I'm here, work it through Deanna.
Okay.
But you know, stop by anytime.
Be right over.
I don't get lonely up here. So, all right. Anything else? Okay. Very good. Well, then I believe Mr. White's online. Hey, Dan.
Hey, Mr. Chairman, how are you?
Good to see you.
It's good to see you. I wish I could be there in person, but I totally understand. We'll have to do Zoom one last year.
Yeah, next year. And for most of the committee, you're familiar with Mr. White, the director of Moody Analytics. And we always look forward to this every year. We always provide a lot of great information for us about the overall economy and some of the pieces, parts that will help us make decisions over the coming year. And we're always very, very grateful that you take the time to be with us. So I'll just leave it at that, and you can kick off your presentation.
Thank you, Mr. Chairman. Thanks again for having me. I thought I'd change things up again this year by actually having a slide deck, so you don't have to stare at my face for 20 minutes on Zoom, just to change it up a little bit. I'm going to share my screen. And I'll make sure that Philip and the staff get a copy of these afterwards so that anyone can have them if they'd like. Okay, hopefully you see a big blue economic outlook in front of your face now, okay? All right, so I'll talk for about 20 minutes, and then as always, I really encourage you all to ask questions if there's anything that you want me to go into more detail on, or if there's anything I didn't cover, by all means, please ask away. I'm going to start off with a disclaimer that most of you have probably heard many, many, many times at this point. Some of you I know can do this for yourselves now, but just for the record, to reemphasize that I work for Moody's Analytics, which is an entirely separate company from Moody's Investor Service, which is the ratings agency. So please don't let anything that I say be misconstrued as having any bearing whatsoever on past, current, or future ratings actions. And if I say that, the lawyers at Moody's get really happy. So I have to make sure that I get that out of the way before we get any talking here. So that said, so Moody's Analytics, on the analytics side, we do a lot of economic forecasting. We do a lot of advisory services. The state of Maryland is a client of ours, and we provide a number of different economic pieces of economic data and economic forecasts to the folks who are working on your revenue forecast very diligently. And before I start, just to say, you all at the state have a really fantastic group of revenue forecasters there. I'm very lucky that I get to work with about 40 states in some form or another on their revenue forecast. And there in Maryland, you guys have one of the better teams I've seen across the country. So you should be very lucky with that. I'll start off with a kind of 30,000 foot view of the economy. Kind of this is the story, the script, so to speak. If everything goes the way that we expect it to, this is what the world will look like, at least over the next several years. The series that you're seeing here is U.S. payroll employment. So this is the number that comes out on CNBC every first Friday of the month. I wanted to show this one because it gives a good overview of where we're going, but also it gives a really good view of where we've been. And I think that's something that, in this pandemic time warp, so to speak, of the last two and a half years, it's really easy to lose perspective on where we had come from just in the last year and a half or so. So at the very beginning of the pandemic, we lost 22 million jobs in about 2 months, which we've run out of synonyms for unprecedented. It's just never happened before. And, God willing, it never happens again. But it was very unique in that because so much of it was because of, I guess, outside exogenous restrictions. So it wasn't happening because there wasn't, demand in the economy. It was really a supply cutoff. The good thing was that when we started to let supply come back on, those jobs came back very quickly. So within a matter of months, we gained back about 10 million of those jobs that we had lost. Now, as you can see, kind of the second half of 2020, it took a little while to get the rest of those jobs back online. And it really was until the end of 2021 when we started to have the vaccinations come online. We had a significant amount of federal fiscal stimulus, including the American Rescue Plan, which came in March of 2021, that we really started to see things progress in line with what we would expect a normal economic recovery to look like. It's actually progressed so quickly that we've actually had to, since the last time I was in front of you, we've had to really make our forecast a bit more optimistic. So some of the things that you're seeing now in 2022, 2023 are things that when I spoke to you all a year ago, you would not have seen until 2023, 2024. So that's actually very good news for the economy. It's so good that the Federal Reserve has actually started to move up some of their deadlines as well. So you can see the Federal Reserve actually began tapering in November of last year. So they're reducing their balance sheets and pulling in the money supply a little bit, or at least reducing the pace at which the money supply is growing. You can see where we are today. Very soon, we would expect there to be a little bit of movement in Washington. A Build Back Better package is still something that we assume happens in the baseline forecast. It might be the most tenuous of the assumptions that we have in this forecast, given some of the political things that are happening in Washington right now. However, we do expect that to be passed. The bill that we do expect to pass, and we'll talk about this in more detail in just a slide or two, will be significantly smaller than we had expected maybe at this time last year. So we assume that bill will be no larger than about $1.75 trillion. We also expect that it will be spread out over a longer period of time. So the immediate economic hit from that bill, the boost from that bill, will be much smaller than what we would have assumed maybe a year ago. Nonetheless, the economy is doing quite well. So, the labor market's coming back. Inflation is starting to kick up much higher than we would have ever expected. And we'll talk about that in a lot of detail here in just a minute. But what that means is that the Federal Reserve has really moved up its timeline for normalizing monetary policy. We assume that there will be probably 3 rate hikes in 2022 to counteract a lot of the inflationary pressures that we're seeing in the economy right now. And that means that the pace of growth by the end of this year will start to slow pretty significantly. Now, that's not something to be too concerned about. That's what we would expect for this part of the economic recovery. And then by the end of next year, we'll probably regain full employment. A quick caveat there is that if you ask 10 different economists what full employment is, you're likely to get at least 20 different answers because it's not something that we can agree on very easily. What we can agree on, though, is that the normal things that we look at, so like the unemployment rate, for example, that's very skewed because of some instances around the pandemic and some idiosyncrasies around the labor force. We'll talk about those in a minute. But basically, once we get to the point where you start to see people like me coming on TV and arguing about whether we are at full employment or not, it's a good bet that we're at least very close, if not there, to full employment. So that's kind of where we expect to be a year from now. So hopefully when I get to come down and eat crab cakes in Annapolis next year at this time, we'll be talking about being at full employment. Okay. Now, over the near term, obviously, there's still a lot of worry out there. And the immediate growth prospects are really going to continue to be determined by the pandemic. So it's as sick of this as we all are, it's going to continue to be kind of a month to month. What do the numbers look like? How comfortable are people going out and engaging in economic activity that drives a lot of the forecasts that we see? The numbers that you're seeing here, this is, I thought, some pretty ingenious data mining by our team. They went on Apple and they figured out how many searches for driving directions there were over the Thanksgiving holiday and how many searches for driving directions there were versus Christmas. So if there's a negative number here, that means that there were fewer searches during Christmas than there were during Thanksgiving. And if you remember, right around November, end of November, early December is when we saw a big boost in the Omicron virus. We saw case counts come up, hospitalization counts went up pretty significantly. So this is kind of a way to put some context around the state by state reactions to the Omicron virus. In Maryland, you guys have been relatively lucky in that obviously you have seen a strong increase in the number of infections relative to what you had had previous in the year. But if you look at the overall number of infections on a per capita basis, you're actually in very good position. I think the last data I saw from last week, you were 5th or 6th in the country in terms of the lowest number of infections per 100,000. Now that's testament to some of the good work that you guys have done in Maryland, but also it's, I think, testament to how bad things are in some other states. There are some infection rates that are really high, and they don't seem to correlate very well with any patterns that we have in vaccination data. And so it really kind of shows it's not just the numbers that are coming out, but it's also the reaction to those numbers that make a big difference in terms of the response to this from an economic perspective. So for example, both New York and Florida are in the top 5 in the country in terms of the number of infections per capita. But you can see that travel in Florida really didn't decline at all during the break between Thanksgiving and Christmas, whereas in New York, it fell back considerably. That reaction, setting the epidemiological impacts aside, that reaction has a big difference in terms of the economic activity that we would have expected to see over the first quarter in particular for those 2 areas. Okay. Now, I'm going to try and not bum you out for a little bit. I'm going to give you some good news. So the good news is, if you look at that forecast, we do expect continued growth in the labor force over the next year. We expect continued growth in GDP and in consumer spending. And the real big reason for that is that there is a tremendous amount of gas kind of left in the tank with this economic recovery. I'm going to leave this chart up for a minute just so you can kind of take it in. Household checkable deposits and currency. This is some data that we have from the New York Federal Reserve. It's one of the ways that they measure the money supply in the United States. And what it essentially is it's household bank accounts, cash accounts, money market accounts, anything that's really liquid that they can access on a daily basis goes into these checkable deposits. In a normal year, we would expect to see somewhere between about $500 billion and $1 trillion sitting around in bank accounts. Right now, that number is at $3.5 trillion, which is the largest number that we have on record. This chart in front of you here, it's not adjusted for inflation, so it's a little bit wonky, but going back to 1990, we've never had more money just kind of sitting around in bank accounts than we have right now. Now, some obvious questions we have for the Federal Reserve that we wish they could give us more detail on, but unfortunately they can't. For example, whose bank accounts is this money sitting in, right? Is this sitting in a couple of really wealthy people's bank accounts, or is this really spread out across the income distribution? And what we can tell anecdotally is that it's pretty well spread out across the income distribution. A couple of reasons why we can tell that. First of all, if it was in very wealthy people's bank accounts, if it was being held by a bunch of really wealthy people, it probably wouldn't be in their bank accounts, right? So this is not something, if you're a multimillionaire, you just keep this money sitting around in your savings account. You put it in towards a much more productive asset than a bank account. So what we can kind of tell from this is that this is probably more spread out among folks in the middle to low income tiers. These are people who maybe live paycheck to paycheck, very rarely have much money in their savings account, who all of a sudden have $4,000 or $5,000 sitting around in their bank account. That makes a big difference in terms of economic activity because people feel a little bit more comfortable to do things. They have savings sitting around that they maybe didn't have, certainly during the initial wave of the pandemic, or even maybe during the Delta wave that we saw over the summer. That should make people a little bit more comfortable in terms of spending money. The other thing that we know about this is that that money is not going to sit in bank accounts forever. Eventually, that money has to flow out somewhere. And so the discouraging thing about this is the bank accounts are probably, from an economic standpoint, the least productive place that people can be sitting their money. We want them either spending their money if we're looking for economic activity, or we want them putting it into a more productive asset like an investment in an equity or any other type of investment asset is going to have much more of an economic multiplier impact than just sitting in a bank account. So this money is going to go somewhere very soon. The question is it going to go out the door as people maybe are laid off or they refuse to come back to work because of safety or whatever reason? Is it being spent, or is it going to flow into the asset markets and actually boost asset prices even further than they already are. But we know this money is going to go somewhere. It's just when and to where it goes that really determines a lot of the rest of the economic recovery. Okay. Now, where did that money come from is the next question that we normally get. And what we can tell is that most of that money is money that flowed into people's bank accounts via the various types of federal fiscal stimulus that we saw during the pandemic. I put this chart up here for a couple of reasons. One, to show you just the sheer size of the amount of fiscal support that we've had in the United States. But also because I found that this is a very helpful, it's really almost a political Rorschach test in terms of the ways that you look at this. So when I show this chart to people, about half of the room will immediately say, you know, that's great for us. Look, the reason we're performing so much better than everybody else is because we really took the initiative here and we boosted the economy and we supported the economy. And that's why we're doing so well, and we should continue to go from there. The downside or the other side of that, though, is that people look at this and they say, oh my gosh, look how much money we've actually put into the economy so far. We've done way more than enough. We should just totally stop this altogether because we're adding tremendously to the national debt, right? From an economic standpoint, from a nonpartisan economic standpoint, they're both right. So we've done really well. We've done better than most countries in the world, certainly the developed world, because we have put so much fiscal support into our economy during the pandemic. It sets us head and shoulders, literally head and shoulders above the rest in terms of our economic activity. The downside of that, obviously, though, is we have added significantly to the federal debt. We've actually kind of accelerated almost a full generation in terms of what we would have expected to see in terms of the national debt. So just for some context, the Congressional Budget Office every March puts out a report that it's kind of projections of what they expect the federal budget and the federal debt to look like over the next 30 years. It's something that I actually look at very closely. I have 4 sons at home, which is a miracle that it's as quiet as it is downstairs right now, by the way, that you're not hearing all 4 of them because 2 of them are home from school. But I have 4 boys, and one of them is exactly 30 years younger than I am. So I always check that report to see, well, this is what the debt to GDP ratio will be when my son is the same age that I am today. And when I checked it last March, it said that basically in 30 years, the debt to GDP ratio would be about 150% in 20 years, or 30 years, sorry. When I checked the most recent one, so the one that came after all of these things were passed, that number is up to about 205%. So in 30 years, we've basically accelerated a full generation in terms of the impact of the debt to GDP ratio. And that's a pretty optimistic scenario. The CBO has some scenarios that are a little bit more downcast that are actually put us on almost 230, 240% within 30 years. So there are consequences to both sides of this. The reason I bring that up and the reason I mention that, though, is that regardless of who is in power politically over the next 5 or 6 years in Washington, D.C., there's going to be forced to be some austerity measures or at least lack of additional spending that comes out of the next thing. So this bill that we assume to come out, this next reconciliation bill, might be the last big spending bill that we have for quite some time in Washington, D.C. And as Maryland, given how much it relies on the federal government, that's something that's very important to pay attention to over the next several years. Okay. Now, the other consequence that comes from all this federal fiscal support, and it doesn't take a PhD to figure this out, if you take $7 trillion and you shove it through the economy over a very short period of time, you're going to produce some impacts in terms of prices. So we've seen that just yesterday, the CPI number came out, the consumer price index came out to show that inflation was over 7% in December of last year. That is the highest number since 1982. And we expect that to continue for quite some time, actually. So this is quarterly data here. So you can see that the fourth quarter of 2021 is a little below 7% because we had 2 months before that were in the 6s. That'll probably accelerate at least through the first quarter of 2022. So we'll probably see inflation continue to stay above that 6.5% rate over the first quarter, slowly starting to come down in the rest of 2022 as the Federal Reserve begins to raise interest rates, pull back the money supply. But it's really not until the end of 2022, early 2023, where we start to be back into what we would consider a normal range of price acceleration. And that is assuming that we have a couple things happen. First of all, we assume that the Federal Reserve continues to raise interest rates and normalize monetary policy. We also assume that the federal government doesn't spend any more money than what is included in the Build Back Better plan. So again, about $1.75 trillion. And then lastly, we also assume that the supply chain disruptions that we're having, they ease a little bit. We don't assume that they go all the way completely, but we do assume that they would make some significant progress on those. If any of those assumptions don't hold true, then what we could have is probably not inflation that goes any higher than the rate that you see in this chart here, but it probably stays at that elevated rate for a much longer period of time. If it does that, then the downside risk is that the Federal Reserve will have to raise interest rates much more aggressively than they have previously planned out. That could result in slower economic growth or even a full-blown recession at the same time that we have prices rising, which puts us into a very similar situation that we had in the late 1970s, early 1980s in terms of a stagflation scenario. That's not the baseline. That's not what we expect to happen, but it's certainly probably the most pronounced risk to the forecast that we have. Okay, I told you I'd bum you out by the end, but I got you the good stuff at the beginning. There are lots of curveballs that are still out there. So this is kind of, we call this the state budget officer graph because state budget officers are always looking for the things that can go wrong next. They're like economists, we're always looking for something to worry about. So this is, if you didn't have anything to worry about, this is a list of things that you can worry about, kind of ranked by the likelihood that they'll occur. So the y-axis going up and down, that's the likelihood of this actually happening. And then the severity in terms of an economic standpoint is on the x-axis on the bottom. So the further out into space you are there, the more likely it is and the more severe it would be to the economic forecast. So the two things that we are most worried about are another wave of the pandemic. So this is something beyond Omicron because Omicron is already built into the baseline. But if we have something else that comes out this spring that potentially causes people to stay indoors and not engage in economic activity for a longer period of time, then that certainly would have a negative impact on the outlook. And then the second one I just talked about is that inflation really isn't transitory. And this really goes back to those supply chain issues. So in terms of the Federal Reserve, raising rates, in terms of the federal fiscal stimulus starting to wear off, those things we're pretty sure are likely to happen. That we don't see anything kind of out of whack there. But if for whatever reason those supply chain issues don't resolve themselves, or if we see a major shock in the energy markets, so some news comes out of the Middle East and energy markets kick back up again, that certainly could cause that inflation to stay high for a much longer period of time. And the Federal Reserve's response will need to be pretty severe, which could cause that stagflation kind of a scenario to occur. There are several other ones here you can see that we're concerned about, but probably not as concerned about as we are with those two. Some of the more likely ones, and actually, like for example, the stock market sell-off, geopolitical event, those are all likely to happen, but probably have a relatively low severity in terms of the overall economic forecast. Okay. Now, tying all of this into Maryland, and this kind of is a microcosm of the full US recovery, and we'll talk about this in a second. The big thing that will drive the pace of recovery is the labor market, specifically the size and the quality of the labor force that you have in your particular state or in your particular area of the country. What I wanted to show you in this chart here, so this is indexed to the beginning of the pandemic, more or less. We have Maryland and the US, the size of the civilian labor force. So these are people who are actively working or who are actively looking for work. And you can see that in Maryland, they had a much deeper fall than the US, but that we haven't really recovered at the same rate that the US has. So there are still a number of workers who have left the labor force in Maryland who have not come back. Now, some of those folks, and we have some really good data on this that we can see from changes in credit scores. A lot of these folks are people who have left Maryland. So one of the things we've seen over the last year is that outflows in Maryland have increased pretty significantly. Inflows have stayed about the same. So the overall population in Maryland has declined over the last year and a half, a little bit more than it has over the past time. So some of these people have left the labor force in Maryland, but they haven't left the labor force altogether. But also what we know, and this goes to the US as well, is that there are a significant number of people who have left the labor force altogether, and they just haven't come back into the labor force yet. So in terms of getting the economy growing at a faster rate or continuing to grow over a longer period of time, pulling those folks back into the labor force is one of the most important things to the outlook, not just in Maryland, but all over the country. So when I'm asked, kind of how do we know we're back to normal? Because remember that most economists can't agree on what normal is anymore. The thing that I tell people to keep an eye on most is this next chart, which is EPOP, which is a really wonky way to say the prime age employment to population ratio. Okay. So when economists are looking for what full employment really means, most of the time, what we're going to look at is we're going to look at this particular thing, which is the prime age working population. So that's folks who are 25 to 54 years old. And the reason we look at this is because we know from previous business cycles, whenever that prime age population, so 25 to 54 years old, whenever about 80% of them are working, then we are pretty much at the top of the business cycle. So going back to 2000, you can see we're just above 80%. We have the recession in 2002, 2003, 2004. We get down under that 80% range, and then we start to gradually work our way back up. Before the Great Recession, we were at about 80%. We dropped down to 75% as a result of the Great Recession, and it took us the better part of a decade to get back to that 80% range. Just before the pandemic, we were working our way north of that 80% range, and then obviously the pandemic hit, and we saw pretty much the largest decrease in the EPOP ratio that we have ever seen. The good news is we've come back very, very quickly. There's several questions that we have for this now is that how long is it going to take for everybody else to get back into the labor force? So how long until we get back above 80%? Our best estimate, again, is that we probably hit that number sometime at the end of this year, early 2023. If you look, this number today, by the way, is about 78.5%. But some of the concerns that we have revolve around the makeup of the labor force. And this is something that's actually very interesting that happened at the end of the Great Recession. There are some folks at the Great Recession who called it a he session. And the reason they called it a he session was that most of the jobs that were lost were in industries that are predominantly filled by males. So in construction, finance, a lot of those were the ones that were hit the hardest coming out of the Great Recession. And you can see, looking at the male EPOP, so prime age men, the severe decline that we saw in 2009 and 2010. And we actually never got back to that previous Great Recession peak before the pandemic. So we're not even getting close to back to where the men were before the Great Recession. In terms of prime age women, we actually saw, significantly surpassed the previous peak in terms of the prime age EPOP for women going before the pandemic. However, women, we saw a much larger decrease in EPOP during the pandemic. And after the pandemic, we have not seen the same level of recovery in female workers as we have in male workers. Some of that's because some of the industries that were hit hardest during the pandemic are those that we know, anecdotally at least, are predominantly filled or historically filled by women. So things like education, things like healthcare, those are the industries where we're seeing the biggest lack of workers in terms of people coming back. The question remains is whether or not those people are going to come back at all, because a lot of the reasons that many of them are out of the workforce up to now are for caregiving reasons. They've got kids who are in school and maybe they're the primary caregiver, elder care, things like that. The questions are, what does it take to pull those people back into the labor force, and will they ever come back? Is 80% is it 80% still the right number that we should be looking at for full employment? Or is 78, 79% the number we should be looking at, in which case we're already at full employment? Those are kind of the things that we're keeping a very close eye on. And in terms of Maryland, and unfortunately, we don't have detailed enough data from the BLS to do this number just for the state of Maryland. As you start to watch this number eat towards 80%, there's a good sense that we are at the top of the business cycle and we start to think about the next recession as opposed to the next expansion in the business cycle. Okay, with that, I think I've been talking for about 20 minutes now. I will shut up and I will be happy to answer any questions that you or the other senators might have, Mr. Chairman.
Okay, thank you very much. Questions? Can you use your raise hand feature? Great, thank you. Senator Jackson.
Yes, thank you, Mr. Chairman. I have a quick question. Thanks for the presentation, Dan. Can't wait to get a hold of the PowerPoint of it. You talked earlier about the job market, and I'm wondering from the impact. We lost 22 million jobs, and we recovered roughly 10 million jobs. And can you talk about the impact, or if you have that information, the impact of the nuances of employment that came back? So we're talking new jobs that folks came back, or they came back to existing jobs, and the uptick of the virtual world of working, right? So the federal government does a lot of teleworking, but I think some of the local governments are beginning to look in that regard as well. And what that, I'm sorry, and what impact that has on the assets if we're going more virtual, these facilities.
Sure, Mr. Chairman, Senator, that's a great point. So I think at this point we've regained maybe about 16 million. So we regained 10 million very quickly, and then there was another 6 million or so that we regained after that. And the jobs that we have regained are not the same ones that we lost. So that's a very good point that you mentioned. So we're seeing a tremendous amount of turnover in the labor force or in the job market. But those folks are not new people coming into the labor force. We're seeing people quitting their existing jobs and taking jobs elsewhere. So the good thing is that they're quitting their jobs, but they're going to another job. The bad thing is, though, it's kind of a net sum game, right? So what we're seeing is that churn creates increases in wages. And when those wages go up, especially when there's a limited supply of goods in the economy right now, we're starting to see that kick more and more into inflation. So it kind of builds upon itself. In terms of the increase in telework, we assume it's kind of one of those things. There are several things that happened during the pandemic that are not necessarily new, but they are maybe an acceleration of some existing trend that we had already seen. So we had already seen telework start to take off quite a bit going into the pandemic. What the pandemic did was just put it at warp speed. And so I think what a lot of people are finding out now is that their future workplace is not going to look anything like their previous workplace. And so we're seeing in the private sector, at least, a tremendous amount of companies pulling back in terms of their physical footprint in the world. So we're seeing this with commercial real estate. We're seeing this with a number of, especially office buildings in particular. We're seeing increases in warehousing and some like server farms, those kind of things. And we're seeing big cutbacks in terms of where we put people, because we just don't need the people. We don't need as large a space to put people as we did. In terms of the state and local governments that you were talking about before, it's very unique in that there's a lot of assets that are kind of very long-term assets that they've held for years. But the other thing is the change in the workforce, that increase in the quit rate that you talked about. So more people are quitting their jobs. The state and local government quit rate is as high as it has ever been. And actually, we have more state and local job openings than we have anywhere else in any other industry in terms of just the percentage now versus what they were before the pandemic. And it goes to what you spoke of earlier, trying to compete with those rising wages. It's hard enough to be a private sector employer trying to compete with those private wages where you're able to raise prices and trying to get them back that way. But in terms of the public sector, you're having to compete in a very difficult labor market right now, and attracting folks into the public sector labor force is going to be incredibly difficult over the next 4 or 5 years.
Appreciate that. Thank you, Mr. Chairman.
Senator Rosebeth.
Thank you. Got a couple of disconnected questions. One is, one of the risk factors you had on your chart of risk factors was an economic meltdown in China. And you guys follow this more closely than I do. And obviously it'd be a big deal if it happened. And obviously people have been predicting it for a lot of years. What's the current state of Moody's more nuanced view of the danger of a real crack up in the Chinese economy, not the politics, but in the economy? I mean, we've got these big bankruptcy going on with these huge firms, all that stuff.
Yeah. Mr. Chairman, Senator, I think the biggest near-term risk in terms of Chinese economic activity is the fact that they are still taking a very hard line view in terms of the COVID response.
Mm-hmm.
I mean, everybody's heard the anecdotes, the Disneyland getting shut down, you know, they're locking thousands of people in the theme park till everybody gets tested.
Mm-hmm.
They are very much going in and they're shutting things down very quickly with no questions asked in an effort to, as I think they're calling it, a zero tolerance policy. What we are most concerned about is the connections between those shutdowns and U.S. suppliers, and the fact that a lot of U.S. suppliers have not been able to diversify their supply chains as much as they would like, especially given where we are in the global economy. I think the big risk there is especially some of the connections between Southeast Asian firms and Chinese firms, because most of those goods right now flow from China to those Southeast Asian firms and then over across either to Mexico or the United States. When China really shuts, the Southeast Asian firms have shown that they are not going to respond in the same way that China is. They're responding more like folks are in the West. But if China continues to shut things down, you know, overnight like that, it could create major disruptions for the U.S.
Okay, well, that morphs to my second question, which is the supply chain problems. It seemed to me one of your charts implied, or maybe I just made this up because I thought you might be saying this. When do you see the majority of the supply chain issues going away? Because they're two different things. The Fed raising interest rates doesn't reduce supply chain problems. It just reduces demand. So what is your analysis on the supply chain issues? And what you just said suggests that if China continues on its aggressive lockdown policy, Chinese-related supply chain problems are going to continue for the indefinite future.
Right. Mr. Chairman, Senator, I think that's the biggest risk to the forecast in terms of in terms of a 50-50 break-even assumption. The supply chain issues in our forecast are probably the biggest assumption that we have out there. We don't assume that those supply chain issues ever really go away, or at least not in the next couple of years. We do assume that they get better. And some of the ways that they get better are U.S. firms are able to
reshore.
They're able to reshore. They're able to at least find other parts of the world that are maybe not under the same risks. Now, there are still inflationary impacts from that as well. I mean, one of the things that we've done over the last 20 years or really beyond 20 years, as we've started to buy more from China and from Southeast Asia, we've really been able to import deflation over the last 20, 30 years. So if we're building those things in the United States, or we're building them anywhere other than Asia or China, we're not able to import that same amount of deflation that we've had before. And so we'll see prices continue to rise even after we get rid of some of those supply chain disruptions.
I'll pass for now, but I'd like to come back to another question after a while, Mr. Chairman. Thank you.
Eckert.
Thank you very much, Dan. And you may have already answered my question when you responded to Senator Jackson, but in your last slide that talked about reaching 80% employment, and if we get to that place, then how that relates to another recession. Could you explain that a little bit more?
Sure, Mr. Chairman, Senator. So we use EPOP. So this is the percentage of people who are employed as a share of the total population, right? So when we look at like the unemployment rate, for example, we look at the number of people who are looking for jobs, or the people who are unemployed as a share of the people who are actually looking for jobs. And because the number of people who are looking for jobs versus people who are pulling themselves out of the labor force, that really goes up and down and can really distort where we are in the business cycle. This number is much more reliable in that it shows the entire population and how many of those people are working. And we know that a certain percentage of folks who are working are not working, and they're not working for a reason, right? They're never gonna work. They're a stay-at-home mom, they're a stay-at-home dad, they're retired. There's all kinds of different reasons why they may not be working. So we know that about 20% of the population, even at the best of times, is going to not be working. So whenever we can get back to that point, we know that's about as full of employment as we're ever going to get. That's about the peak that we can get. And the goal of the Federal Reserve and policymakers is to try and keep it at that 80% for as long as we possibly can. But we know when we get to that 80% level that there's really nowhere else to go but down. So once we're at 80%, the only way to continue growing employment is to grow the labor force, so either by importing workers or by naturally growing the population. So it's kind of one of those things where you're climbing a mountain. Once you get to the top, the only place you can go is down. And so maybe you can stay at the top for as long as you want, but eventually you're going to go down. So when we see it get to that point, we know we should be watching for another recession, because we really can't physically get any higher than we are in terms of that place of employment.
So as we create more jobs and we're able to get more people back into the workforce, we really still have a need for more workers, right? And
absolutely, Mr. Chairman, Senator, the only way to keep this at 80% forever is to keep growing the labor force at the same pace that you're growing everything else. So at a state level, what that means is not only growing them organically, for the state, but also importing people. So getting people to come to your state as opposed to going to other states, and getting workers to come to your state is a way to continue to do that, because it's a zero-sum game once you get up to that 80% level.
thank you, because we have a number of businesses where we do have difficulty importing labor or recruiting labor that is significant, particularly in the rural areas. So thank you.
Senator Elfreth.
Thank you, Mr. Chair. Dan, thanks so much. This is my 4th year in the committee and 4th year hearing this presentation. And the first 2 years, we talked about, we were kind of on the incline and a recession was coming. And then COVID occurred and we have a lot of inputs into the economy. My question is going off of Senator Eckerd's question about indicators of a recession. Have we created such an artificial bridge from where we were with COVID to kind of going right over where what normally would have been a natural recession? Or are this indicator right here that's on the screen, we will get there in the next couple of years, if not eventually?
Mr. Chairman, Senator, one of the few things that economists can say with any level of certainty is that there will be another recession, right? So it's just a unfortunate reality of economic life. It's very likely that without the pandemic, we probably still would have had a recession. Lord willing, it wouldn't have been nearly as severe as it was. But we probably would have, we were due for another recession just about that time anyway. Mm-hmm. So what we might have done though, by injecting so much federal fiscal stimulus in, is just kind of fast forwarded through a lot of that business cycle so that we're already getting to the other end of the current recovery that we're in. Now, how severe that looks, again, with all that cash sitting in bank accounts, means that it might just be a very brief recession. It might be, again, very similar to like 1981, 1983, where we had 2 small recessions right in a row. Mm-hmm. It definitely fast forwarded us to where we would be in the business cycle.
Okay, thank you. Thank you, Mr. Chair.
Senator Stallings.
Thank you. Thank you for this great presentation. I'm looking forward to getting this and even more so getting into the dissecting, I guess you could say. But I'm going right along with this. I think you somewhat answered it, but I'm looking at the job rates and where we're at right now. And the problem that we do have is just getting people out there to work. I know by state jobs, federal jobs, private jobs, even people with that want to be entrepreneurs and the general industry. Where do you see maybe the better opportunity in areas where we can, pick up those jobs and maybe have more of the opportunity for the rate to go down? If that's a good question, I appreciate that. Thank you.
Mr. Chairman, Senator, that's a fantastic question that a lot of people are asking right now. And I think it's especially important in Maryland. I mean, this chart, I think, shows it that there's been fewer workers have come back in Maryland than in other places. Over the long term, to Senator Eckhart's point, it's attracting more workers from out of state, trying to get them in your state as opposed to going somewhere else. Given there's so many states and so many job opportunities in such a small area around your state, that's something that you can really focus on. But the other part, and this is more near term, what we're seeing anecdotally is that folks are not getting back into the labor force for two reasons. Either they don't feel safe getting back into the labor force, which is a smaller population than we had originally. But then two is the caregiving issues, it's the schools. It's getting, I use an anecdote for myself. I was speaking at a conference in October or November. And it always happens when I'm about to leave on Sunday night to go to a conference. Our school called and said that there were too many COVID exposures that week. And so that they were going to do everybody virtual for that week. And so I'm telling my wife at 9 o'clock on Sunday when I'm flying out Monday morning that all 4 kids are going to be home with her for the entire week while she works, while I'm going to be at a business trip, which is fantastic, right? For a really great anecdote during the speech that I had to give the next day. But at the same time, it was informative because we are very fortunate. My wife works from home. She stayed home with the kids. It didn't bother us one bit at all, right? But if we had been a single parent household, I might have had to cancel that trip. My wife might have had to take 4 days off work. There might have been all kinds of disruptions that happened in our economic lives as a result of that. And most of the US population lives in that kind of a reality. So as long as they're worried about childcare, as long as they're worried about not being able to cover for kids getting home from school, the bus driver shortages and all that stuff, that's really what's going to cause a lot of people to get back. And when they feel comfortable enough that they can go back to work full time and not have to have their lives disrupted like that, I think you'll get more of those last people that are still on the sidelines back in the labor force.
Thank you.
Sarah, did you have another question?
Oh, I'm sorry. No.
I'm going to jump in with one, then we'll go to Senator Rosapep. So really kind of a strictly planning our budget question. And we clearly have got a lot more revenue than the state has ever seen before, both in terms of one-time money, and we also have out into the future a pretty good look on our structural situation. You match that with the questions of inflation, and I think about the things that government has to buy. And in many ways, I suppose we buy a lot of the same things that in the overall economy buys. But I wonder how long we can anticipate sort of being in this upcycle of revenues and still be able to buy what we need to buy and provide the same level of services that our citizens have come to expect. Will we, are we, obviously I think this first year going into this, we're going to have this revenue. We're going to have this one-time revenue in particular, but what happens the next year? Are we really going to, or is it going to catch up to us? Is this experience of having a lot of extra dollars around going to go away?
Mr. Chairman, the fact that you're already thinking like that means that you are well ahead of the curve when it comes to other legislators that I talk to around the country. I think a lot of people are kind of overwhelmed with how much money they have. When I used to work, a dozen years ago, I used to work at the state of New Mexico for their legislature. And I remember one of our Senate pro tem senators always saying the only thing that's worse than having not enough money is having too much money, because it becomes very difficult to say no to things all of a sudden. Focusing just on the revenue side, it doesn't tell the complete picture, because you're going to have all that money, but all those costs are going to go up the same amount as well. So as we just talked about with inflation, you're probably looking at inflation this fiscal year of 6 to 7%. So if you just did everything the same you did last year, it would still cost you 6 or 7% more than it did. Looking at the next fiscal year, you're probably looking at less, but you're still probably looking at around a 5% increase in the overall cost of goods and services that you're consuming, not counting in any changes to wages or other things that you're trying to build into that. So we need to keep those in mind when we're doing budgets. To your other point, though, especially with the federal funds that are coming in, it's exceptionally important not to make sure that the one-time monies are spent on one-time things. Because if you take one-time monies and you try to incorporate it into recurring spending items, then what happens is, as you mentioned, in a year or two, when that federal money goes away, you're going to be on the hook for funding whatever increases in spending that were from your own organic sources. So matching up those funding streams for one-time recurring versus non-recurring is incredibly important going forward.
Thank you. Senator Roosevelt.
Thank you, Mr. Chairman. Again, two unrelated questions. I think in your projection, you assume no fourth, fifth, or however you want to count, no more big surge of the virus. Is that correct? You assume that Omicron is the last one?
Mr. Chairman, Senator, yes. So we'd assume that Omicron is the last one that really materially makes an impact. There might be other ones, but they wouldn't have much of an impact in terms of the economic.
And I'm deeply curious as to why you're making that assumption based on the history of viruses over the millennia, based on the last year and a half of our experience, based on what the public health people say. That seems like an outlying projection. So why do you come to that conclusion?
Mr. Chairman, Senator, from an economic perspective, it's not really an outlying projection. We're actually a bit more conservative than the blue chip consensus, if you look at the consensus forecast right now. However, in terms of those assumptions, it's very difficult to, one, pick up the size, the magnitude of any additional outbreak that might happen, but two, also the timing. We can make assumptions about maybe this time next year when we all go back inside again, that we'll have another outbreak and numbers will go back up because everybody's inside again. But trying to put any hard number on that in terms of a forecast is very difficult to do. So what we do is we try and be as conservative as possible with that, but then we outline the fact that if there is a significant outbreak, so one that causes us to reimpose lockdowns or things like that, that's a downside risk to the forecast.
Okay, well then let me look at it more quantitatively. What is your estimate of the impact of the Delta variant, the economic impact of the Delta variant last year? And what is your estimate of the current and likely projected over the next month or two economic impact of Omicron?
That's a great question, Mr. Chairman, Senator. We've been looking at that. Right now, our estimate of the Delta impact was somewhere about 20 to 30 basis points in terms of real GDP for the US.
Okay.
So assuming Omicron is somewhere in that neighborhood, what that means is that next year, instead of seeing 4% GDP growth, you see 3.8% GDP growth.
Well, so basically you're arguing that the economic impact of the two most recent surges is not very big.
It's significant, or it's material, but not significant.
Yeah, it's material, but not significant. Yeah, it makes sense. But I mean, okay, but no, that's very helpful. Unrelated to that, you had a lot of vertical analyses of this industry, that industry, as you always do. Do you provide your analyses on those vertical bases as part of the state's contract with you? And is that stuff that we can get your up-to-date forecast related to the sectors?
Mr. Chairman, Senator, yes, they have access to our forecast of employment by industry out for 30 years.
Okay, and Mr. Chairman, if we might ask our staff to make that available to us, I think it'd be helpful on some of the micro issues we're going to deal with this year.
Very good.
Thank you very much.
Senator Young.
Yes, thank you. Population projections you mentioned for Maryland, we've on an average gained 40, 50,000 people a year for the last 30 years. The numbers I've seen for the last year, there was a decrease, not as large as the one you mentioned, but whatever it was. Do you see a reason for that? And do you think it's a trend? I mean, I don't think the country lost overall population. Why do you think this year Maryland did?
Mr. Chairman, Senator, maybe just to clarify. So the numbers I was talking about were actually migration numbers. So that would have been separate of any organic growth. So any births, deaths, differences. So this is just the number of people coming into Maryland versus the people leaving Maryland. You've had that deficit there for some time, but the organic growth has been high enough to keep it either neutral or just a little bit above. We have different data that we look at that is a bit more up to date. Unfortunately, I can't share with you the exact numbers because they're proprietary from one of our partners, so I can't give you the exact numbers, but we have it up to the month. And the partner that we work with is one of the credit reporting agencies. And we find that we can see when people change addresses a lot more easily and their data up to date than we can using the Census Bureau data or the IRS data, because that data is obviously very lagged. And so what we have seen up until about the fall of 2021, when we have the most up-to-date data, is that the people who are coming into Maryland, that number has stayed relatively stable. But just in the last 9 to 12 months, we've seen the number of people leaving Maryland increase pretty significantly, to the point where net migration for Maryland, domestic migration, has actually turned much more negative than it has for some time.
Do you have a reason for that?
Mr. Chairman, unfortunately, I don't. The only thing I can come up with is a good kind of story to fit that data. And this is something that we're not seeing just in Maryland. We're seeing this in the entire Northeast, is that people are migrating to, because they don't have to be in a large metro area to work anymore. They're moving into lower cost areas all over the country that seem to work better in terms of commuting, or not commuting, but telecommuting. Again, that's supposition based on the little bit of data that we have, but it would certainly fit what we're seeing in a lot of other Northeast and Mid-Atlantic metros. Or sorry, states.
Thanks.
Okay, we're going to take 2 more questions. You still have a little time, Dan?
Yes, sir.
Yeah. All right. So Senator Alfrith.
Quick follow-up on Senator Young's question. Dan, do we happen to have an age breakdown of the folks leaving Maryland?
Mr. Chairman, Senator, unfortunately, we don't. We really just have the total net amount of data.
Okay, thank you. Thank you, Mr. Chair.
Last question, anybody want to jump in? Well, looks like no takers. You must have answered it all. And with that, I just want to thank you once again. We really appreciate it. Very insightful. And we'll carry this. I know I took a page full of notes as you were talking, and I'm sure we'll refer back to your words and ideas as we go forward during this year. So thank you very much.
Oh, it's my pleasure. Thanks as always.
Committee, that is it for today. I think, I guess if we look on, I think Tuesday is our next, is our first bill hearing. So that's our first time, although I think there are some subcommittee meetings, if I'm not mistaken, or briefings on Monday. So good to see you all. Good to be back, and we'll talk soon. Thank you.